You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option, the program designed for busy financial advisors and asset managers who are looking to find new ways to incorporate options into their clients' portfolios, as well as all of you out there who are maybe looking for a new financial advisor or asset manager and want to know what skill sets they should bring to the table. My name is Mark Longo from the optionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. A lot of new additions to that network you may want to check out, including if you're interested in a lot of this options education that we touch on here on the program, then I encourage you to check out our new Options Playbook radio program that breaks down all of these options concepts you may want to learn more about and some interesting sports metaphors, offensive and defensive plays, and all that fun stuff. You can check it out at Options Playbook Radio. And while you're there, of course, if you've been paying attention to all of this news and the headlines about high-frequency trading and technology and flash boys and whether the markets are rigged against you and all that fun stuff, then you'll definitely want to check out our new program, Trading Tech Talk, where we break down all of the interesting technology that powers these markets behind the scenes. A lot of great guests on that program, a lot of great stuff to check out. Of course, you can find both of those programs wherever you find the Advisor's Option. And while you're checking out those new additions, make sure you check out our brand spanking new mobile app available for iOS, Android, and Amazon Kindle Fire. You can instantly stream all of your favorite episodes of the Advisor's Option. You can download them for offline listening. Let's say you're hopping on a plane or on a train and you want to catch up on some back episodes. You can, of course, do that with the app. And while you're listening to stuff in the app, you can always hit that email, hit that question button, and shoot your questions, your comments off directly to the host of your favorite programs. A lot of cool stuff. Check it out. The Options Insider Radio Network mobile app. I think you're going to like it. All right. And we got the gang all assembled here for the Advisor's Option, starting off with the man beaming in from Puerto Rico by way of Durango, Colorado, the co-founder of Swan Wealth Advisors, Mr. Randy Swan. Randy, welcome back to the program, sir.
Thank you very much. It's a pleasure to be here.
And beaming in from the headquarters of the Options Industry Council, he is the Director of Education for the OIC, Mr. Alan Gregoletto. Alan, welcome back to the program.
Nice to be here, Mark, and nice to hear your voice again, Randy.
All right, and last but certainly not least, beaming in from RCM World Headquarters here in scenic and sunny downtown Chicago, Mr. Mike Cavanaugh. Mike, welcome back to the show, sir.
It's great to be back. Randy, congrats on the move to Puerto Rico. Alan, always good to hear your voice.
Same here. Good to hear yours.
We got quite the love fest brewing on the panel today, listeners. So without further ado, we're going to keep on rolling into our first segment, The Buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz. This is, of course, a portion of the show where we break down some of the interesting developments and trends and stories we're seeing coming out of the industry that may interest you, the financial advisor, but you haven't had a chance to keep track of. And Alan, seems like a lot of stuff's coming out of your neck of the woods lately, so I think we'll start there. Everyone in all aspects of the derivatives world and the financial advisor world has one eye on China these days. They're looking to see what's coming out of that area. Of course, they're adding listed derivatives. They added them last month, actually, and plan to roll out more in the coming months. So a lot of interest, a lot of tension, a lot of potential volume, and a lot of potential new clients coming out of that area of the world. And I know you guys just announced a new deal with the Shanghai Stock Exchange. Why don't you walk us through what you guys are doing with that exchange and what that could bring to the table for even the listeners of a program like this?
Well, thank you. Yeah, we're really excited about what's happening in China. It's been a long process. It may seem to some of the folks that it's kind of new information, but actually OIC has been going back and forth with visits to China over the last 5 years, and we've gone every year, usually in the fall. And we've gone on there with only one goal, to promote the responsible use of exchange-listed options to Chinese investors. It really picked up steam this past fall when myself, Mary Savoy, and Bill Ryan from New York Stock Exchange went to Shanghai, Shenzhen, and Taipei to work with educators on how to more or less clone our style of educating the public. The Shanghai Stock Exchange, and in particular the CSRC, which is their SEC, really wants to have a good experience for their options exchanges, and I believe there's 5 exchanges that will launch options, not just the large caps like Shanghai, but also options on commodities and small caps and a few others. And what they don't want is a repeat of what happened a number of years ago was with warrant trading in Shanghai and elsewhere in China, where the investors didn't feel they were getting a fair shake. So the CSRC has been working with the exchanges there, and they working with us to gain a better understanding on how best to inform their client base on how options should work. One very, very positive result of our trip to Taipei was we worked with the Taipei Foundation of Finance. And through their educators, almost all of them PhDs, attending 4 days of intense classes that we gave there, they are now registered with the Taipei Foundation of Finance and can teach in Mandarin essentially all of the options education materials that we have here at OIC. So we're very excited about that. We've kind of cloned them in our own teaching methods. They'll go out through China and help investors learn about the product.
Well, that's a good thing, and certainly from everything we're hearing out of that neck of the woods these days, there is a lot of demand, a lot of opportunity for that, and I know a lot of our listeners out there are wondering what's going on out there and how that can impact them. So it's good to see that you guys, the OIC, have boots on the ground in some capacity over there and are helping to shape the way options are approached over there in China, because in many sense of the word, it is like the early days of options here in the States, and there's a lot of areas for things to potentially go wrong if they're not handled properly. So good to see that you guys are on board and helping to do what you guys do here and on the show and throughout the country, which is to spread the gospel of options. Speaking of spreading the gospel of options, this next story here in the Buzz segment, it just annoys me so much it had to go up here on the rundown. This is an article coming out of our friends at Markets Media. There's been a lot of analysis of what's been going on in the pension and asset managing world of late. And we've talked a lot on this show in the past about the problems that a lot of guys like you guys have, Randy, and others, RCM and others have with making inroads into the pension world and getting them to understand the risk management value of adding options and indeed derivatives to their portfolios. And we're seeing more examples of that right now. And the article I'm looking at here, they cited one particular pension fund. This was for the, I think, United Church of Christ pension fund, but the actual fund doesn't matter so much as their approach, which I think is emblematic to a lot of the funds out there. This particular fund, like a lot of them out there, and indeed like a lot of financial advisors these days, they were very focused on the fixed income side. Not surprisingly, that approach hasn't exactly been lighting it on fire the last few years for a typical bond fund. So they're looking at restructuring their approach, going into different segments of the fixed income. Now, you think income, of course, you would think options listening to a show like this. And you would also think they're looking at protecting themselves. A lot of the focus of any sort of fixed income type portfolio is indeed on risk management, risk mitigation. And yet this large fund, emblematic of many funds out there, they said they've seen a lot of increase from their clients in interest in adding things like multi-asset funds and things like that and really broadening their approach. Here's the actual quote from the CIO of this fund, which I thought was emblematic of a lot of the problems facing this industry. He says, "We expanded the fund's reach into other fixed income opportunities, which included newly adopted satellite strategies that offer greater appeal, in particular greater diversification and higher long-term expected returns." He said, "Even so, our bond fund still refrains from shorting the use of derivatives and leverage." That was in their press release. That was a bolded out quote. They wanted that out there front and center. Hey, we don't use any derivatives. I think anyone here on this panel would recognize that that is a very dated, a very antiquated approach to things like risk management. Mike, you must encounter this viewpoint quite a bit, that there's a lot of funds out there who are having problems generating income, who are having problems generating returns while still keeping their risk profile in check. And yet, for whatever reason, this seems purely like a PR type reason, refuse to embrace any sort of derivative instrument. This must drive you crazy and must have to beat your head against this wall on a regular basis.
Well, it's absolutely. I mean, we still haven't figured out the perfect way to crack the communication nut, so to speak, when it comes to derivatives. You know, I would have several questions for the person who made that quote, and it seems like you said it's a PR announcement. You know, the public may have a different perception of what he means by derivatives. You know, all the stuff in 2008, you know, the sell-off in 2008 was derivative laden and leverage laden, but it doesn't speak to options. I think sometimes people just lump options into derivatives and don't really truly understand that they were created to hedge risk, and that if you're looking to hedge risk while you still have the potential of increasing the income in the portfolio, options are the natural fit. And it is frustrating, but you know, we've got great tools out there to use, and you know, usually the people that get it and take the time to understand it will, you know, you can communicate it. But you know, the broad statements of "we don't do any derivatives," it kind of lumps options in. So it is somewhat frustrating, but there's no perfect way to explain in a 20-second quip, you know, what your firm does or what your management style does in that capacity. So, you know, nobody's really cracked the nut yet, so to speak.
And that's why we don't call it the Derivatives Insider Radio Network. That's just the D word we try to avoid at all costs, because it is very much a pejorative term like it's being used here. It's just thrown out in a press release. We don't touch those derivatives. By the way, I dug a little bit further into their release, talking about the strategies that they do approve and that they do use in their quote-unquote satellite strategies that they are looking to experiment with to increase return while keeping risk steady. They include high yield, which of course everyone knows means higher risk. Bank loan, that's pretty much neither here nor there. And then emerging markets debt portfolios, another area where I would imagine there's a large concentration of additional risk. So they're going to be adding all these new areas that have a lot more risk to their portfolio in order to try to juice up some returns, and yet none of the risk mitigation strategies that we've talked about here many times on the show. It's very frustrating. Whenever I see these stories, I have to put them out there. Now, Randy, you guys at Swan represent one of the few groups that have had any sort of traction really in this space, attracting any players to your overlay type strategy. What's your response when you hear someone running a very large pension fund make this kind of blanket statement? And do you think this is still emblematic of the way a large number of the pension funds out there and endowments really feel about derivatives, or is this perhaps starting to go the way of the dodo?
Well, I think this is a long process that's going to take years to play out. I think that things are improving, but I think it's slower than I think we'd all like. And I think that what I would like to see is I'd like to see some of these debates actually at different conferences and forums to really hash this kind of argument out about, options or derivatives are evil and everything else seems to be good. It seems to me like the industry is chasing yield, chasing more risk, when they should be doing things, making investments that is actually less risk and a little more managed risk is what I would say. But until we get those forums, I think we're going to continue this battle.
Alan, you spend a lot of your days traveling to different advisor firms and asset managers and to pension funds and trying to spread that gospel. I know earlier in your time there at OCC, that was pretty much the response you guys received was, we don't touch those derivatives things. Are you seeing some evolution in that space in the last couple of years that you've been doing this?
Yes, there's some movement there, but you'd be surprised that the first kind of call that OIC gets is the call that they're not really equipped to kind of address. And you spoke about the pension funds starting to go after emerging market yield and those kinds of things. Well, if they're in emerging market yield, they just, as a byproduct of that, they're going to have currency risk. And so they want to know how they can hedge currency risk using derivatives, which isn't our expertise. But at least it's a step in the right direction that they recognize that there's a currency risk to buying some of the sovereign debt that's not Eurozone debt or U.S. or U.K. debt. So they understand that component of it. Now, will they apply what they're learning there also to equities? I don't know, but one of the things that we're doing in conjunction with the University of Notre Dame, and you might have heard me speak that we always try to collaborate with a study every year with a university on an options overlay strategy or several options overlay strategies that can help provide statistical evidence of the advantage of using them in both a income and protection style. We've got this study with Notre Dame, and it's essentially it's Mike's favorite strategy, the wheel trade, the covered strangle, and the early results of this from the University of Notre Dame are very, very positive over the long haul. Now, I won't release all of the details here on the call, but as soon as we do get the report approved and ready for release, I think it'll be something that we'll be able at OIC to take to a pension manager and say, hey, look, if you were thinking about a strategy that might suit your portfolio, rotating out of stocks above the market, 10% or so, and also having short puts in the marketplace at price points where you want to acquire or add to positions, this might be a suitable strategy. So that's kind of where we're moving down the road, is to give us some tools that we can show to a pension fund that are apropos for a portfolio management tool.
That's one of the things I like about what you guys do over there, Alan, is that you actually help people arm themselves with the data to confront issues like this. I recently got a frantic email from a friend at a very large brokerage firms getting pushback from one of their managers saying, hey, we shouldn't be introducing our equity retail clients to options. And he said, help, I need some data. And one of the first things I always do to them when I get those kinds of emails, which are unfortunately very frequent, is to send over some of the great OIC studies that you guys have done on things like the collars in the past. And I'm very much looking forward now to this new covered strangle study, because again, the more data we can have to use to confront viewpoints like this, the better it is. Speaking of these kind of odd viewpoints and looking at the pension mess is very much global. Looking at what's coming out of the UK these days as well, they're having some interesting problems with a lot of their pensions out there. They're saying that their pensions are losing out on about what they claim to be about £2 billion a year in potential returns by having what a lot of their pension funds essentially just lumped into these passive index tracking type funds, these passive index tracking type events, but they're being charged very, very active type fees for that, and that they're essentially just getting very, very nominal returns. Some of the very scary takeaways from this article, again, this one coming from our friends over there at Markets Media, saying that the pension trustees over there usually only have 1 day each year for investment issues, which they spend on asset allocation, which is a terrifying prospect. If that is indeed the case, they spend 1 day a year looking at what investments are actually held in these funds. And looking at the breakdown here, they talk about how there's over £2 trillion worth of assets in the variety of these different funds. And what they're essentially saying here is that they would really love to juice up those returns a little bit, keeping the risk the same, if not better. And that, of course, speaks instantly to exactly what you guys are doing over there at Swan, Randy, which is taking a simple S&P 500 tracking portfolio and putting an overlay on top of it. And now you have risk mitigation. You have some income component as well. You can add that extra put for the put spread to add a kicker to have even more income to offset even more of the cost of that protection. And now you can have essentially a passive portfolio with some sort of active mitigation on top of it. And they say they want to do that and then add some sort of bespoke custom benchmark that is actually suitable to that type of strategy. So while they don't mention options per se, it certainly seems like a great opportunity to start that conversation over there in Britain. They seem to be more willing than perhaps our friends over there at the previous pension fund we just talked about to at least explore some new opportunities and, of course, some of the new different strategies that we constantly discuss on a program like this. So what do you say, Randy? Is your next stop going to be over there to Heathrow to start talking to some UK pension funds?
I would love that opportunity and welcome it, and I think it's something that has a lot of potential opportunities for firms like ours, as well as other firms that would like to go into this kind of area. I think it's just, like I said earlier, it's a matter of time before people see the benefits. They get ingrained in their old religion, and it's hard to tell someone the religion needs to be updated or modified.
Yeah, they just kind of stick to this old school index tracking type mentality. They're paying, seems like, substantial fees for a very, very nominal type return strategy, and for taking those same type of fees or a portion of them and allocating it to someone who could add some sort of optionality to that portfolio would seem like it would be a winner for all involved there, because that's the exact type of use case we're constantly extolling. And you could take that and break that down to an individual financial advisor, or even to your own individual retail account if you want to start using some of these strategies we talk about here on the show, like Alan just mentioned: the wheel, the covered strangle, the simple overlay, the collar, which I've called many times the holy grail of the financial advisor and asset manager from an options perspective. There's a lot of strategies that we've used on this show and mentioned on this show many times that would be ideally suitable. So if you're the individual advisor out there, you think you're alone with this problem, or even perhaps the individual retail client who thinks you have the similar problem, you can't even beat the indexes on a regular basis and you're paying too much to do it, then you're not alone. A lot of large national pension funds share your pain, and they're looking for ways to get around that.
Yeah, I just wanted to add, I think in the traditional investment portfolio view of having stocks and fixed income portfolios, you're allocating a certain amount, let's say 40% towards fixed income. Now that the interest rates are so low, I just want to circle back and just add that that's where we're getting the most interest right now, is to say, normally you'd allocate fixed income. Now you're questioning whether or not you should allocate anything to fixed income, or at least minimize that allocation. We think using options in a portfolio really is a solution to that, because you're really not allocating a very large percentage of a portfolio that is probably not going to generate any significant returns going forward due to the low interest rate cycle. So it's actually one of the comments that the Morningstar did on our mutual fund was made the comment that the Swan defined risk strategy can actually be used to replace a traditional 60-40 portfolio because of the interest rate components of what's going on right now.
Speaking of the indexing, which is always an interesting approach, a lot of advisors like to take that. Our good buddy over there, Charles Schwab, the actual founder, not the firm, but the founder of Charles Schwab, who's been in the headlines quite a bit lately. I believe we have a listener question about him a little bit later that we'll get to. But he was at a conference this week, I believe, and talking to Market Watch. And he's been out there beating the drum again about indexes, saying that indexes are the ideal approach for 95 to 98% of the American investing public. It says we need to get the word out there because people are now coming back in the market. In 2014, someone who got out in 2008, 2009, what's an easy way for them to get back in? What's a cheap way to get back in? Of course, he promotes indexes and index-linked funds. But it is interesting to see a lot of people beating that drum again for indexes, which I think is something we can all support here on the show. If that's a good approach for a lot of people, I think, provided they also take those additional approaches that we've discussed here on this program in the past. Things like you guys over there at Swan do, Randy, which is the overlay, or perhaps just buying a put to hedge it, or if they want to go the extra mile and constructing the collar themselves, or doing a lot of interesting things like that, perhaps using the wheel to get into an S&P 500 SPY or SPX type position, and then writing calls against it to get out of it. A lot of different ways you can take that approach in a bit more actively managed capacity, but still have that passive style index approach. I know, Mike, you guys over there at RCM are big fans of the index type approach, using things like SPY and writing options against it. What's your take here on our good buddy, your good buddy, Mr. Chuck Schwab, extolling the virtues of indexing to a lot of the audience out there, including a lot of financial advisors? Another reason why I pulled this story up is because Charles Schwab obviously represents a significant swath of the financial advisory community as well.
Yeah, that's not that profound a statement. I think John Bogle said those exact words in 1957 when he started Vanguard, that if you don't have the time to invest into stock picking or active management, or you're not working with an advisor that has a team that does that, that's a common sense statement. Yes, indices are ideal for long-term investors because of the correlation to the return. The S&P, if you put 60% in SPY and 40% in an aggregate bond index, and the fees are extremely low, and your time horizon is 30 years, I don't think there's someone anywhere that would argue that, yes, indeed, it is a better place to be than trying to go after an active manager. But there are points in time where you want to use an active manager. So any broad stroke statements about investing, I always kind of roll my eyes, because there is no better or best for anyone. There's a best or better situation. And to say 95 to 98% of Americans are better off in index funds, it seems like a very broad stroke statement. But Charles Schwab gets time to talk, and has the press to say those things. He can't give a 4-hour dissertation about the history of investing and why he's saying what he's saying. He's going to take a shot at being concise and clear, but I don't disagree with what he's saying. The context of what he's saying, it's important to understand, and a lot of people just don't have the time to educate themselves on when it is important to look outside of just investing in index funds.
And one of the reasons I want to bring that up on a show like this is because, well, number one, Schwab obviously has a very large reach in the financial advisor world. So when he's out there extolling the virtues of indexes and index type funds, that means a lot of the advisors out there are probably going to be receiving that information as well and getting a lot of push from Schwab to push that onto their clients, which I'm sure they're already doing. So in that sense, whatever Charles Schwab says does resonate very strongly in the financial advisor community. So for that sense, it's worth doing. I think also to add our 2 cents to it here on a show like this, we're of course not averse to indexing. It's not a bad approach by any means, and it is suitable for a wide swath of the investing public. I think provided you take some of the approaches that we've extolled here on this show in the past. Again, like we said, constructing overlays, buying protective puts, doing collars, things like that to improve those returns. Otherwise, if you're just going the passive index route, you're getting back into that same problem we just mentioned before with the UK government waking up to the fact that they've been wasting a lot of time and resources on that type of strategy and perhaps underperforming, particularly from a fee perspective. So if you are just going to take that approach, make sure you probably add a little bit of your own active component, or if you're an advisor, you add that active component. Or if you're a retail client, you ask your advisor to add that active component to get those returns perhaps a little bit more in line with what you would expect, and certainly get your risk levels. Otherwise, you're just tracking the market up and down, and really, we've all seen how well that can perform over time, particularly in areas like 2008, 2009, if you're not particularly careful. And if your only risk mitigation strategy is to be long the index fund and then go into cash, then you're missing a few steps in between. A couple other things really quick I want to hit on before we move on to some of your feedback, some of your listener mail as well. Speaking of Charles Schwab and the retail scene in particular, there's been a lot of drum beating coming out of the different brokerage world that retail is still scared, that volumes have been light, even given the protracted nature of this rally, that people aren't participating. A lot of retail-oriented advisors worried that their clients maybe don't want to come into the markets or aren't ready yet. We're seeing some data that may be controverting that a little bit. They're saying the equity trading volume moving towards snapping a 4-year slump. In particular, they looked at a lot of the big retail brokers out there saying E-Trade looking pretty good. Customers buying a net nearly $4 billion worth of securities in the first quarter, matching the strongest buying since the company began reporting metrics 5 years ago. Schwab, E-Trade, and TD Ameritrade, the combined daily average revenue trades at those firms increased 24% in the first quarter from the previous year, hit this highest level ever from the combined three firms. Again, this isn't options, this is equities, but you can draw some parallels to the options world as well. So that is indeed an interesting development. A lot of people out there, a lot of advisors who are perhaps worried that now is not the time to bring your clients back into the equity markets. Well, a lot of your clients may be doing it already without you being aware of it. So interesting stuff coming out of the equity brokerage world. And let me just wrap up here on the old buzz segment with, I'm sure, what a lot of you guys have been hearing out there in the financial advisor community from the financial media is, of course, volatility, aka the VIX. The VIX is low. The VIX is cheap. What does that mean? Remember, we had a show about volatility earlier. I encourage you to dive back into that episode in the archives if you really want a lot more of a deep dive into volatility. Of course, we also do that on our Options Bootcamp program and take a regular look at the volatility space in our Volatility Views program here on the network. So a lot of alternatives for you guys to check out there if you want to deep dive into volatility. But just as a refresher, of course, the number that everyone's quoting these days is, of course, the VIX cash. And that number closed below the 12 handle on Friday, down to 11.5 actually, and is vacillating around those levels today. So that is seen by many people to be historically low. The exchanges and others have been putting out this number of the long-term average of the VIX being around 20. And so we're somehow destined to make a big move. But I would personally just caution a lot of you out there that if that is indeed your view, that volatility is low, there is a historical perspective. I was out in the S&P pit a long time ago. And back then when vol got around this level, it was seen to be pretty high. And when vol got into the mid-teens, it was extremely high. And people were aggressively selling it. So my frame of reference perhaps a little bit different than what we've seen over the past few years with VIX vacillating into the 20 handle and beyond. But still, I would caution you to be a little bit wary of all these pronouncements that VIX is cheap, VIX is cheap. Volatility is indeed mean reverting, but doesn't have to revert tomorrow. We could languish in this area for quite some time. So if you're in the option writing side of the fence, it may be a little bit difficult for you to find those attractive covered call levels, short put levels. You want to get into a wheel trade. It may be a little bit more difficult for you to find those attractive trades. On the flip side, if you're an advisor out there constructing portfolios with long premium elements, in particular protective puts, this is a great time to perhaps start looking at ways to construct those portfolios and save yourself a few basis points by taking advantage of this volatility that is quote unquote low. Alan, when you go around to these different firms these days, the pension funds, the asset managers, even the hedge funds, are they cognizant of this? Are they giving you any feedback about, hey, I'm hearing about this low VIX. What does that mean for me? Or is this still a little bit too far into the weeds for them?
I think it's a little bit outside of the scope, talking about long volatility plays for their clientele. I will say that most of the folks that we've spoken to of recent past are pretty happy with the returns they've gotten from the marketplace over the last few years, especially last year with the S&P, up nearly 30%. And I think one of their concerns is that they don't want to give it back. So, the questions we've had around option strategies is, how do I buy protection for a portfolio without incurring a drag on the return, which is, of course, not buying naked puts, so to speak, but rather having some kind of way to pay for that long put, either from a short call in the construction of a collar, or a short call plus a put spread, which is even a cheaper way to pay for it. So, general rule of thumb, if you're buying portfolio insurance and the guy has a look-alike portfolio to the S&P 500, and he's going to buy, not short-term protection in the form of weeklies, but something like 6 months out or so, it's, you're looking at a roughly about a 2% cost. And when you're trying to sell that to a client as a good thing, even with volatilities low, they often aren't willing to give up 2% when they're fighting with their advisor over fees that are 1%. They say, wow, that's a lot of money. So I think you have to, for the advisors who are very savvy, there's ways to do this and do it at a very, very low cost to protect your portfolio. And I agree, the volatility is exceedingly low, in the marketplace after such a tremendous run-up in the market over the last 5 years, but it doesn't mean it can't go lower. I seem to recall, I don't know what the record low is at the cash level, but I seem to recall that, back in the 90s, it actually penetrated below 10 on one of the VIX readings. I don't remember which calculation it was, but maybe we'll break that record. Who knows?
Now, Randy, I would have to think that along those same lines, that this would be very, very, very favorable territory for you guys right now. That's constant drumbeat that VIX is low, that volatility is low. That, of course, translates into cheaper costs for constructing these types of overlays. Are you seeing increased interest in some of the funds out there and some of the active pension funds and asset managers? Or, again, like Alan was saying, is this maybe a little bit too deep in the weeds for them when you go to meet with a fund that, hey, volatility is low, therefore the cost of constructing this type of overlay is a little bit more attractive right now?
We always look at it from two different sides. We explain to people that, relatively speaking, it's very cheap right now to insure your portfolio without trying to make it market call. And, of course, we're always very agnostic or neutral to what we think the market's going to actually do. Our strategy is not really based on making market calls. But the other side of it is, the negative side is, obviously, as you mentioned earlier, it's the income writing strategies are not going to generate the kind of premiums they would normally do in a higher volatility environment. So we always explain that as offsetting, which is, of course, the nature of hedging. There's a good side and there's a bad side. So everything else being equal, we tell people, hey, to insure your portfolio after the run-up over the last 5 years is we think is pretty compelling from a risk management perspective. But also we would like to have a higher volatility to generate income. So that's the discussion that we have. But we do have a lot of advisors that realize that they've had a good 5-year run, even though their clients may not have been 100% exposed to the market, and now is a good time to at least start having those conversations with their clients.
Yeah, you're right. That is a little bit of the double-edged sword of the collar type strategy, particularly the way you guys construct it with that extra short put leg there. There is that double income component, which does suffer in an environment like this. So I suppose it depends how you want to term it, how you want to view it. Glass half full, glass half empty from a low vol perspective. Mike, take us home here. You interact a lot with the retail clientele, the retail end through your guys over there at RCM. Are you getting a lot of those calls right now, like Alan was just mentioning? But this is, of course, an ideal time. People are experiencing run-ups in the marketplace. A lot of them are sitting on profits in their various trading accounts. Volatility is low. It is a cheap time to put on that protective put type position.
Yeah, all very good points both Alan and Randy made. The conversations that we have with clients, the not the difficult conversations, but the more involved conversations happen while they're not clients, while we're bringing them into being clients. We ask a lot of questions about what their expectations are. The paradigm that most interests me are the people that are invested in the stock market. They've defined that their time horizon is retirement. Let's say it's 20 years from now, and they say, I want to make 12% a year. If the market's up 30% and it's down 15, I don't want that. I want to be up 12% a year. Well, the market doesn't work that way. And if you invest in the market without employing a strategy like Randy's, where it's included in a portfolio. If you're a 60-40, 60% stocks, 40% fixed income, shaving some of that down and putting it into a hedged equity strategy, an option overlay strategy, really what you're trying to achieve is you're taking the volatility of the return out of the portfolio. Why is that important? We know that left to our own devices, if we don't know how to do something, it's probably not the best thing to do. Like if my plumbing at home broke this afternoon and I ran home in an emotional state, we'll call that volatility. There's water all over the floor and I grab a hammer and I start whacking the toilet. I'm probably not going to really help the situation. And to convey that back into investments, really what we're talking about using a strategy like Randy uses is you're taking the emotion out of the decision making process. And when you take the emotion out of the decision making process, you're less prone to call up when the market's down 20% and change your plan. So, to answer your question and throw in an analogy and all that other stuff, the conversations we have with our clients happen when we're bringing them to be our clients, explaining to them that the long-term volatility is what we're looking at hedging. And the purpose for that is to take the emotion out of the decision-making process so we don't change plans when the markets are making lows or highs, smoothing out the volatility. So we do get calls from people, and I 100% agree with Randy. The calls now have been more along the lines of, we'll call it the people that are thinking a little bit proactively, more so than groupthink. Hey, the market's made a nice run here. The last time I was invested for a period of time like this where the market had a nice run, it came down. I'm not saying it's coming down tomorrow. And like Alan hinted at earlier, it could take 2 years for the market to correct 10, 15, 20%. But if you're starting to think about it now, you have an opportunity to hedge some of the volatility that may come into the marketplace. So we have been fielding calls along those lines, but then we don't shift the conversation to, making it friendly to a strategy in how we tailor the portfolios the way we see fit, no matter what the conversation is.
All right. Unfortunately, that's all the time we have for the Buzz segment this episode. And now we're going to keep on rolling into your segment because it's time for the listener mail.
Listener mail. Listeners write in. Mailbox.
All right, everybody. Welcome to the listener mail segment. As the name implies, this is, of course, the portion of the show where you guys get to take the reins and let us know what's on your mind, what questions are burning up your inbox and therefore our inbox these days. We got a lot of them to get to, so I'll get to as many as we can this episode. Starting off with a question from Neil Staffenberg. He writes, "Thank you for this program. It is very informative." Well, you're welcome there, Neil. He goes on to write, "I've heard you mention SMAs on this program in the past. I'm not familiar with this term. Can you explain what you are referring to and the significance it has for the advisor community?" Well, Randy, maybe I'll toss this one to you. I believe your cohort, your colleague there, Mr. Mark Sebastian, was talking about SMAs on our very last episode. So maybe that's what he's referring to, Mr. Staffenberg. So why don't you go ahead, Randy, and explain to our friend here, Neil, what is meant by SMAs and why that term is relevant to the advisor world.
Well, SMA stands for separately managed accounts. Swan offers our strategy on a separately managed account basis, the 40 Act fund, as you know, option overlay, and as well as Swan Re. So that's just a term that we use in the industry, and that's when an advisor will typically come to us and say, "Hey, I love your strategy. Want to offer this to my clients. I want to do this on an individual basis." So that means that we have an account for each client on an individual basis. And the benefits to that are basically you have an account that's in your name. You get to see every single trade that goes through the account. It's not tied to any additional money that comes in or leaves during the strategy, unlike that occurs in a mutual fund. So there are some definite advantages to an SMA program, and that's really what we offer at Swan is we offer those accounts to other advisors for their clients on an individual basis.
There you go, Neil. Hope that answers your question. Sometimes we do bandy about a lot of alphabet soup here on this show, and we sometimes forget that not all of our listeners know exactly what we're referring to. All right, great question, Neil. Next one comes up from a listener, goes by the handle Avow. He writes, What do the hosts think of recent claims from advisor-centric firms like Charles Schwab that the market is rigged against individual investors? Should I be instructing my advisor to move me to cash? Is purchasing a put sufficient protection to my broad portfolio, or are the options market rigged against me as well? Well, interesting question, Avow, very timely. A lot of people up in arms about this topic. I mentioned it earlier, talking about Charles Schwab. I knew we were going to get here in the listener mail. But of course, what he's referring to, listeners, is the recent, I suppose you can call it post-Flash Boys hysteria, that book making the claim that the market is rigged against the individual retail investor. Charles Schwab, not the firm, but the man himself, adding a little bit of fuel to that fire when he came out and said things like high-frequency trading are a cancer to the markets that are disadvantaging the little guy and therefore should be eliminated. So there's been a lot of vitriol thrown back and forth on both sides of the fence. I encourage you, if you're really, really into that debate and that type of content, then serve on over to our new Trading Tech Talk show where we get into that in a lot more detail. But of course, the focus of the show on the advisor side. And you're right, Mr. Avow, Schwab is indeed a very advisor-centric firm. So what they say tends to go for a lot of the advisor market. Maybe first off, maybe Mike, will start with you on this, because I'd imagine, first off, you haven't had a chance to weigh in on this on any of our programs yet. So I'd be curious to see what you have to say about the whole Flash Boys brouhaha. And then B, are you seeing some of this filter into your clients? Are they calling up concerned about this and about the markets being rigged against them?
So I haven't fielded any calls about the market being rigged against the retail investor. I have made it, probably my life's work here to educate people on what an investment in the stock market means. And like I mentioned before, I mean, we do all of that prior to a client becoming a client of ours. They, understanding all the fees involved, what the firm goal in the relationship is, what the investor's relationship is. So I can see why people say, oh, it's rigged. It's like anything else. If I wanted to be an IndyCar racer, and I'm just throwing that one out there because I watched the race on Sunday. If I showed up at Indy tomorrow and said, all right, I really enjoyed the race on Sunday and I want to be a race car driver, they would probably laugh at me, and I would feel that because I don't have the experience racing, maybe I didn't get a fair shake. I might just be a great IndyCar racer if it wasn't so rigged against me, the guy that wants to be an IndyCar racer. I mean, it's ridiculous. The thing that people don't understand about the stock market there are no visible entry barriers. Randy is a great example. Randy's been managing his fund since 1997. That's almost 20 years of experience. You're getting an experienced IndyCar driver, so to speak, in the money management world. My company has money managers that have been doing this for over 15 years. And for people to say, oh, this is right. No, there's just as many entry barriers. You have to work with professionals that understand how to race around the track in the investment world. And if you're not, there's always the opportunity for somebody to say, listen to me, listen to what I'm saying. The odds are stacked against you. It's rigged. And of course you're going to get support. But I don't agree that it's rigged. I think it's just like anything else. If you want to get ahead, you have to work with the people that are going to help get you ahead in the race, so to speak.
Well, I would just like to add that I think at the end of the day, what you're really trying to do is find advisors, find money managers that you believe at the end of the day have a system that will actually provide value to your investment program over time. That's the key. And I don't necessarily believe that someone has an end that no one else can overcome. I think that's my kind of fundamental belief is that there's a lot of good advisors, a lot of good money managers out there that can find a system that will provide value to you over time. And it's not always about beating the market per se. It's about reaching your goals and objectives on a long-term basis and giving you a system, quite frankly, that allows you to succeed. And that's the way I would answer that.
Mark, the only thing I would add to that is I don't agree at all that the markets are rigged, and even with all the brouhaha over high frequency trading, you have to look at our market structure as it stands today, and then only look back in time to what we had 25, 30 years ago, and do a comparison analysis between the contraction in the spreads, the reduction in the cost of execution, the transparency in the quotes, and the level playing field that the investor has today versus what he might have experienced back when exchanges were ruled by specialist systems. And I think all of us on this call would have to agree that the investor is markedly better than where he was many, many years ago. Is it a perfect marketplace? By no means, no, but it is iterative, and all the exchanges and the contributors to the financial markets are always trying to make it better. And I know that each of us on this call does our own part to help make those markets better for investors every day.
Great question, Mr. Avow. I won't weigh in on the markets are rigged stuff because I've already done that quite a bit. Check out the Trading Tech Talk show for more on that. But I will get to the specifics of your last parts of your question here. You said, should you be instructing your advisor to move you to cash? Well, that's a personal conversation you have to have with your advisor. If you're worried about these levels in the marketplace being overblown, then maybe you want to go into cash. That's up to you. I wouldn't do it because you're scared of the markets being rigged. That doesn't really make much sense. And you also ask, is purchasing a put sufficient protection to your broad portfolio, or are the options market rigged against you as well? Well, all of us here pretty much don't subscribe to that market being rigged philosophy, but even if you did, even if you were one of those people, tinfoil hat wearing people who says the markets are rigged against you, all the stuff they were profiling in that book, the latency arb and all that stuff like that, that was all focused on the equity side. We really haven't seen much penetration of that at all into the options realm for a variety of reasons. The systems are more complex. The products themselves are more intricate and more complex. There are more series and more strikes than just flickering an individual equity. So we haven't seen a lot of that activity really make it into the options world because it's just too difficult to do. So even if you did worry that the equity market was rigged against you, options a much, shall we say, safer, less rigged environment. So if you come in and you're worried about protecting your gains, like we just talked about earlier with Alan, buying a put is a great way to do that. As long as you work your levels, you have a limit order in mind, so you don't pay too much, you don't come in with a crazy market order, you should be fine. It should be a sufficient way to protect your gains in the marketplace right now. So don't worry, Mr. Avow. All right, we have time for one more here. This is an interesting one, comes in from Tim Nichols, writing out of sunny Fredericksburg, Virginia. He writes, can you provide an overview of the CBOE put right index? The BXM has been discussed widely, but I haven't come across much discussion or analysis on this sister product. From all the research I've encountered, the product appears to perform quite well. It seems that structured products that include automation are the preferred tools for many financial advisors and planners. Would the panel recommend the put right index as a viable alternative for advisors looking to add options to their portfolio without the hassle of writing the options themselves? Good question here, Tim, and this is an interesting one, actually. This is not a product, you're right, that gets a lot of play out there in the broad media. We've touched on the BXM ourselves on the show several times. That is, of course, listeners, the Buy Right Index put out by the SIBO. There are a number of funds and ETFs linked to that index, and what that essentially does is replicate holding the S&P 500 in a portfolio and writing at-the-money covered calls against it. What he's talking about is another product called the Put Right Index, and what it does is essentially, from a risk perspective, the exact same thing, but in a little bit different methodology. What it does is it writes at-the-money puts on the S&P 500. But instead of holding that basket of funds, what it does is it holds cash in equivalent to offset that put being assigned against them. So essentially, it writes cash secured puts on the S&P 500. And he's right, there is some performance differences in the two, even though if you know options, they are synthetically equivalent, and from a risk perspective, they are equivalent. A lot of that has to do with the minutia of the way the put right index was constructed here, Tim. I encourage you, if you want to learn a lot more about really diving into the minutia of the put right index, I encourage you to check out the archives of our Volatility Views program. We had the actual creator of the put right index on that program, and we got into a lot of these details in a lot of specificity. So if you want to check out why that put right tends to outperform the BXM, then check out that program. I think if you're interested in doing things like this, I know a lot of advisors are interested in what we're talking about here in terms of writing puts and things like that, but they don't have the time. The put right is a great alternative for that. The one thing I would caution you about is that because it doesn't have a lot of the broad traction that BXM does, there are fewer funds and ETFs linked to put right than there are to BXM. In fact, at the end of the day, you may be better off just going with BXM because you have more options, pun intended, from an investment vehicle perspective than you do with PUT. Again, the ticker symbol PUT, you can check it out for yourself, see if you can find an index or an ETF that is linked to that you like, I think is a great product. I think it performs very well. It does what it intends to do, but you may have to go with the sister product, the BXM, because there's just more out there that's available for it. Alan, we've talked about this point many times on the show in the past. Automation, like our listener says, is the key to getting a lot of advisors on board with using things like covered call strategies and things like that. Have you seen a lot of interest from the firms you talk to in some of these quote-unquote automated type strategies like the BXM that takes the covered call portion out of the equation for you and rolls it automatically?
Not so much on the put right, but certainly on the BXM for the covered call. That is always a good talking point whenever you're bringing up covered calls and as an optionable strategy for a client. So obviously we applaud what the CBOE has done in this area, in this arena. As you mentioned earlier, the put right strategy is starting to find its way into some funds and some optionable products, and I think they've done pretty well. I know I got a couple of results last year, and as you might expect with a rising market, the put right strategy is really outperformed in a very large way. We'll see if that ever becomes mainstream. I would be surprised. It's often the hardest thing to get anyone to really understand that a covered call and a short put are essentially the same. But hopefully, if we keep plugging away at this, folks will understand that, and maybe put writing will become a good strategy, at least if not mainstream, something that could be done inside of a IRA portfolio where client is just putting short puts in there to buy the stock anyway and looking for the return as a byproduct.
Yeah, once you get into that risk equivalency synthetic conversation, you can see their eyes start to glaze over. So it is a difficult conversation to get into, but if they're doing things like PUT and BXM, they should be aware of that. Mike or Randy, anything else here for our friend Mr. Nichols before we wrap up?
Yeah, I would just add, like Alan said, if the CBO wants to get this more widespread, they should have named it MXB, which is kind of, take the PUT out of it. If you just looked at no naming anything, and you put the BXM on a sheet of paper, and then you put PUT on a sheet of paper, there's no investor in the world that would pick BXM. Just from the strict, it's performed better with less volatility than the BXM. But because you called it the put index, because it says PUT in the ticker symbol, well, puts are scary. I'm not going to do that. It's crazy, but I think from what it's accomplished, it's a good product. I'd be interested to hear what Charles Schwab thought about it as well. It is an index. It seems to me to accomplish a lot. It is automated. It's strictly rules based. It's a good product. I think more of it has to do with the psychological misnomer of it being a put.
All right. Unfortunately, that is all the time we have for the listener mail. But don't worry, if you wrote in, we'll get to you on a future episode. Keep those questions and comments coming. We love to see your feedback. We read it all, even if you don't get a chance to answer all of it here on the program. And before we go, as always, let me check in with each of my cohorts, my partners in crime on the Advisors Option panel to see what they have coming down the pike that may interest you, the listener. Starting with you, Alan. I know you guys over there at OIC are cooking up an interesting conference in New York that some of our listeners here may be interested in.
Well, thank you. Yes. We're on our third Thought Leadership Forum in conjunction with ICE New York Stock Exchange, which will take place on June 12th. It is invitation only, but we're looking for advisors who want to learn from other advisors on how to use an options strategy for their clients. And so roughly about 120 seats. I think we probably have about 20 or 25 seats yet remaining. So if you're an advisor, you're in the New York area, you can reach out to the New York Stock Exchange, find a representative there that you're familiar dealing with, and I'm sure they'll be able to get you an invitation. It is a free event.
And Mr. Kavanaugh, what's coming down the pike over there at RCM Wealth Advisors?
We've got an event coming up in Charleston, South Carolina on June 26th. if anybody's interested in that, I don't have the details of where it is in Charleston in front of me. But we talk to advisors about using alternative investments within their retirement portfolios for their clients, option strategies, along with managed futures strategies, basically trying to get a non-correlated to the S&P or non-correlated to a modern portfolio theory portfolio. We work with advisors to show them the nuances and educate them on how to accomplish this if their clients are asking for it. So that's coming up. We've partnered with McGladrey, the CME Group, and Millennium Trust to bring this to multiple cities. So we've got a few more stops, Charleston, then Dallas, Denver, and Miami to round out the year. So if there's any interest in that, let me know. If you're in one of those cities, we'd be happy to sit down and chat with you.
And unfortunately, Randy couldn't make it here for the end of our program. But if you want to learn more about what those guys are up to, including their mutual fund and the Swan Re, and indeed their overlay strategy that they could add to your portfolio, then surf on over to swanwealthadvisors.com and check it out for yourself. And on behalf of Randy and Mike and Alan, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and for making it such a success. And we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.